Hello everyone! Today is May 26, 2025. We need to talk about options trading. What is it really? Think of it simply. An option is not a stock. You are not buying a piece of a company yet. Instead, you are buying a choice. The choice to buy or sell a stock later. This choice has a price. It also has an expiration date, a deadline. It is like a reservation for that stock. A special coupon with a time limit. Now, why would you want to trade options? Many people do it. Some do it for potential profit, of course. Others use options to protect their other investments. It can be a smart move like insurance. For some, it is also very exciting. But here is the Orman rule. You must understand the risks. There are big risks involved if you don't know what you are doing. You cannot just jump in blindly. You must learn first. Option prices are not static. They change all the time. Many different factors can make these prices go up or down. It is not just about the stock's price itself moving. Time is a huge factor. How much time is left before the option expires really matters. How much the stock price jump around in the future, its volatility, is also key. Even things like interest rates can play a small part in these price changes. It is a dynamic world. Because it is so dynamic, we need help. We need tools. Tools to understand these changes better. Tools to measure the risks we are taking. Tools to help us make smarter decisions with our money. This is where our special helpers come into the picture. They are called the Greeks. Now, they are not actually people from Greece, but they are very, very wise when it comes to options. They will guide you. So, what are these Greeks I'm talking about? They are simply measurements, financial metrics. They tell us how sensitive an options price is, sensitive to different things happening in the market. Think of them like the dashboard in your car. Your speedometer tells you your speed. Your fuel gauge tells you how much gas you have left. The Greeks give you similar, very important information about your options. They are indicators. Why should you care about these Greeks? Why bother learning them? Because they help you understand potential risks. They help you see potential rewards more clearly. If you decide to trade options and you ignore the Greeks, it is like driving your car blindfolded. You would not do that, would you? Of course not. So you should not trade options without understanding these vital tools. They give you more control. They help you make informed choices, not just guesses. Now, I want to be very clear. The Greeks are not crystal balls. They do not predict the future with 100% certainty. No one, and I mean no one, can do that in the market. But what they do is give you a much better idea of what happened. They help you prepare for different scenarios. They help you manage your hard-earned money wisely. And managing your money wisely is always approved. Knowing is so much better than guessing, especially with investing. There are a few main Greeks that we will talk about. Each one of them tells you something different and specific. But when you look at them together, they paint a much clearer picture. A picture of an option's behavior and its potential changes. Learning about them is like getting a superpower for your trading. Honestly, it helps you see things, important things, that other people who don't know them might completely miss. And that is a very, very good thing for your financial health. Let's meet the first member of our Greek squad, Delta. Think of Delta as speed. It tells you approximately how much an option's price might change. This change is for every $1 move in the underlying stock's price. For example, if an option has a delta of 0.50, its price might move about 50 cents for every $1 the stock price moves. Delta shows you how closely connected the option's price is to the stock's price. A high delta means a strong connection. A low delta means a weaker one. Next up is gamma. Gamma is a little more advanced. It measures how much delta itself is expected to change. So, if delta is like the speed of your option's price change, gamma is like the acceleration. It tells you how quickly your option's sensitivity, its delta, might change as the stock price continues to move. Delta isn't a fixed number. It changes. Gamma helps you anticipate how fast your speed, delta, might pick up or slow down. This is very important for managing dynamic positions. Then we have theta. Theta is all about time. Tick-tock, tick-tock. And as we know, time is money. This is especially true with options. Theta measures how much value an option might lose each day. This loss happens simply because it is getting closer to its expiration date. This is called time decay. All other things being equal, options lose value as time passes. Theta shows you the estimated amount of this daily decay. It is usually a negative number because it represents a loss of value. Finally, let's touch on Vega and Rho. Vega measures an option's sensitivity to changes in volatility. Volatility is how much a stock's price is expected to swing up and down. If people think a stock will be very jumpy, its implied volatility will be high, and Vega will be important. Vega tells you how much an option's price might change if this expected volatility changes by 1%. Rho measures sensitivity to interest rates. It tells you how an option's price might change if interest rates go up or down by 1%. Rho is usually less of a focus for short-term option traders, but it is still good to know it exists. Understanding these Greeks, delta, gamma, theta, and vega, is not just an academic exercise. Oh no, it is incredibly practical. It is all about helping you manage your risk. That is the most important thing. For example, knowing an option's theta helps you understand how much value it could lose just from time passing by. Knowing its delta helps you estimate how much you could make or lose if the underlying stock moves. This is powerful information. You are no longer just guessing in the dark. You are making calculated decisions. You can also use the Greeks to build better, smarter trading strategies. Do you want a strategy that potentially profits from the passage of time, from time decay? Then you need to look at options with certain theta characteristics. Do you want a strategy that could benefit from big, unexpected stock price moves? Then you need to pay close attention to vega and gamma. The Greeks help you select the right options that align with what you want to achieve in the market. This means you can be more targeted. You can be much more intentional with your trades. Our wonderful friends and partners at the Westside Day Trading Group really understand this concept deeply. They use the Greeks every single day in their trading. They know firsthand how absolutely essential these tools are for making informed, smart decisions in the fast-paced world of trading. That is why we are so happy and proud to partner with them. They provide such great insights and valuable education to their community. You can learn so much from experienced traders who use these concepts daily. They help make complex things simpler to understand. So, what is the bottom line? If you truly want to get smarter about your options trading, you must learn the Greeks. Please do yourself this favor. It will make a significant difference in your understanding and your approach. And if you want more tips, more insights like these, and if you want to join a supportive community of learners, please do us a small favor. Like this video, subscribe to our channel. It really helps us to continue bringing you more valuable content like this. It helps us support you on your financial journey. Let's all get smarter with our money together. Thank you for watching.